What's going on, you guys? Shiraz Ahmed here, and in today's video we're going to be discussing IRAs. We'll be talking about two of the main different types and why you choose one over the other. So please stay tuned. Alright, welcome back, you guys. So, really, the following discussion applies to people with earned income living in the United States. Now, before I get too deep into this topic, please consider hitting that like and subscribe button, as it really does help out the channel. So, that being said, you probably heard about IRAs, or traditional IRA, or a Roth IRA, but what do these acronyms even mean? And what's the difference between them all? So, an IRA stands for an individual retirement account. And these accounts are meant to help you save for your retirement. So now that you know what IRA stands for, can you guess what Roth might stand for? Now this is a trick question because it actually doesn't stand for anything at all. It's named after the sponsor of the legislation that created this tax-preferred account. His name was Senator William Roth. The traditional IRA deposits are tax deductible in the year that they're made at both the state and federal level if you participate in a qualified retirement plan, such as a 401k. Now, if you're covered by qualified retirement plans, IRA contributions are only deductible if your modified adjusted gross income is below certain levels. Deductible IRA contributions will lower your adjusted gross income, which, if brought under certain levels, can help you qualify for other incentives like child tax credit or student loan interest reduction, etc. So, when you withdraw these funds later in life, they'll be taxed at your income tax levels at that time, which is generally in retirement. Again, I'm saying this generally, incomes are typically lower for most individuals. However, if you withdraw this money before age 59 and a half, you'll actually get a 10% early withdrawal penalty as well. Now, you can avoid this penalty, but not the taxes. If you use funds for things like higher education or first-time home buyers' expenses up to $10,000, by age 72, you'll actually be forced to start withdrawing a percentage of this account, and that percentage actually keeps ratcheting upwards as you get older. Now, any IRA contributions that are not deductible due to income limits will form the non-taxable cost basis inside of the IRA. All right, now looking at the Roth IRA, which actually works a little bit differently. The two biggest key differences are in taxes, and more importantly, how they're affected and the income limits. Now, let's talk about the taxes first. With Roth IRAs, you don't get to deduct your contribution from your income taxes. Now, on the other hand, withdrawals you make during retirement are totally tax-free if you're age 59 and a half and older. And Roth meets the 5-year clock as well. You can also withdraw any amount up to what you've contributed to in the Roth without any penalties, even if this occurs before age 59. Roth IRAs also have no required minimum distribution. So they make a fantastic vehicle to transfer of wealth. Beneficiaries of Roth IRAs do not owe any tax on the withdrawals if the Roth meets that 5-year clock, though they are required to take distributions or roll it into their own IRA account as well. Now, by the way, see our video on what to do about inheriting IRAs by clicking here. There are a few restrictions that you should be wary of if you're looking at these accounts. Now, these limits apply to both IRAs. First of all, there are limits on how much you can put in each year. So for the 2021 and 2022 tax years, this amount is actually $6,000 if you're age 50 or older. You could top that up with an additional $1,000, bringing the total contribution for the year up to $7,000. And the second limit is the income limits for these types of accounts. This amount needed to hit the limit depends on whether or not you're filing as a single, married filing jointly, or married filing separate. Now, you should really check online for these numbers since they actually end up changing every single year. So now, how do you choose which one is best for you to use? The short answer is, it depends. Obviously, everyone's situation is unique, so the only really way to know whether one is better than the other is to ultimately run the projections with either your financial advisor or a planner, or even just yourself using some calculators to run some simple scenarios. That being said, A lot of the time, it comes down to your current and expected future tax brackets. Are you going to be making less money in retirement than you are now? Traditional IRA is probably the best bet. Now, if you're expected that your income will actually be higher in retirement, then the Roth IRA is a better choice since future withdrawals will not be taxable at your higher future tax rate. Now, your income and other eligibility requirements will also influence your options, so make sure you take into account all the variables when making your final decision. Well, I hope that was a helpful video for you guys. This is jam-packed with some information, and yes, it was short and sweet, but in there are some nuggets that I think that you could take away and hopefully have a positive outcome on your retirement savings. We know it can be hard to find reliable current information, so part of the goal of this channel is to continuously provide that to you guys. As I mentioned earlier, if you've made it this far, please do consider hitting that like and subscribe button. It really does help out the channel. And until next time, please stay safe out there, you guys, and bye for now.